What do you do when a customer prepays you for services? In the cash basis, income is you recognize income when you receive the cash, regardless of when you perform the service. But if you're on the accrual basis, you recognize income when the service is done. So since you'll be doing a part of that portion of that income on an ongoing basis, maybe they prepaid you for 12 months worth of recurring work. Well, you have to account for the fact that you're only going to earn 1/12 of that income per month. So just like anything else, you do invoice payment or sales receipt using the only difference is now the invoice and the sales receipt normally deposits to an income account, but in this case, the income will or sales receipt, the invoice or sales receipt will deposit to a liability account. So you have an item type called deposits, which would be a liability account. Then you make the deposit and then you add it to your bank feed match. So at this point, the income is not being recognized in your book yet. So every month, once you do that, you create a recurring deferred charge and a recurring deferred credit. So this is automated. This will be automatically generated every month. From that, you create an invoice. From the recurring deferred charge, create an invoice. And then from the recurring deferred credit, you add the credit to the invoice. So the net invoice amount will be zero. But what that invoice is going to do is it's going to take the amount from the liability account and put it to the income account. So next, we'll see how this is done in QuickBooks. Let's see how this is done in QuickBooks. Well, first of all, we'll create the invoice so the customer can pay the prepaid amount or the deposit, whatever you want to call it. We'll write the customer's name, the type of deposit, prepaid service. We might put more details there for what they're prepaying for. Like prepaid service, I might write 12-month gardening. It's 12 months at the rate of $300 a month. They're taxable. So that's what they'll do, save and send. If they already paid us, and all we have to do is just receive the payment, then we can use the sales receipt. With send and close, the customer will pay. So when the customer pays, if they don't pay through Intuit, we'll have to go into the customer center, or we can go to the invoice, whichever one. So let's say they sent us a check. We'll have to receive that payment. So they sent us check $325. We'll save and close. So let's go to reports. Let's take a look and see what's going on so you can see what's going on. On our profit and loss statement for today, we have nothing. And then let's take a look at our liability on the balance sheet statement. So we can see we have that deposit of $3,600. So that's where it's saved. It's not income yet. So now every month we're going to turn that to income by creating the delayed credit. So it's 12 months worth. Let's see what we did first. They paid us $3,600 and they paid us at the rate of $300 a month. So the delayed charge we'll just use the same day to make things easier. Will be $300 a month. So we'll use the income account. So we'll say gardening, $300 every month. Save and close. We'll make that recurring. Save template. For purposes of this, since the template is not going to show now, I'm just going to go ahead and create another delay charge. Well, actually, what I'll do is I'll just go to the recurring templates and use it. And then we also create a delayed credit. Oops, wrong one. Delayed credit for the same amount. And this time this will come from the deposit account. 300. So every month Oh, that one I didn't make recurring. You have to make that one recurring too. So every month that becomes recurring, automatically created. So now let's go to the recurring templates. And then use now, save and close, and use now, save and close. And then we go back. So now we want to create an invoice from this. And we want to add that credit. Then we save and close. We don't have to send it to them. So now let's look at what happens. When we go to the income statement now, for the first month, let's just look at today. For simplicity, I'm making it so we can see that $300 income. And when we go to the balance sheet statement, you can see that's also going to be reduced by $300. So now our balance is now $3,300. The deferred charge and deferred credit is a great way to go if you don't bill at the same time every month and you need that flexibility, because it gives you more flexibility as far as when you bill the invoice. However, if you're invoicing exactly the same every month, you can just bypass the delay charge and credit and just create an invoice every month, a zero-based income invoice every month. So you first of all start with the service, and then 300, and then you go ahead and take the money out of the deposit account minus 300. So you see that invoice is zero. We save and close it. And then when we look at the profit and loss statement, let's go for today. You see that $600. And look at the liability account. See the liability has also gone down by 600. So you can use either workflow. Just bear in mind that when you need more flexibility, delay charge and delay credit is a better way to go.